morning, everyone, and welcome back to Trade Evade. Hope you guys are all having a great day. Um, I'm Ryan Razbiani. Good morning, everyone. I'm your host. Welcome to Market Simplified on Place Your Trades Network. We're the network that focuses on trading daily options using CME Group's event contracts to trade the indices, metals, energy, and Bitcoin futures markets. Today's broadcast is brought to you by TradeAvate, which has built this custom app dedicated to trading event contract, which is where we use here at Place Your Trades. So we got a lot of exciting stuff to discuss about. We got a lot of ton of market data that came out today that I want to discuss with you. We got more market data coming out tomorrow. If you're new to the show, we got a simple format, 30-minute show. We go over the market overview. We go over some today's price actions, and then I discuss the cool event contracts with you guys to kind of prepare you and teach you first of all what they are and show you how would use them and how you can use them too for your trading. Especially, it's a really cool tool for new traders. So let's get started. Here. Sorry, just 1 second. I need to close this. All right, so starting with the macro overview of what's going on. So I want to go through some of the data that's kind of come out today. That's what's really important. Taking a look at it, so you can ignore some of the stuff up here unless you're into the housing markets. You can watch that. But the ADP non-farm employment change data came out. I put in a full thread on what ADP non-farm employment data is, as well as the JOLTS data. I created like a little thread. It's got like 8 little sub paragraphs on my Twitter if you want to read that. But it says here that we added 497. There's a 497,000 change in employment, which signals what? The labor markets are still very strong. That gives Jerome Powell a runway to continue to raise rates if he wants to. He has hinted that they're okay with a lighter and kind of softer labor market, which means probably, unfortunately, more unemployment. And that means that here, what the labor markets are telling him is that, hey, well, what's going on right now is okay. Like, you have more runway to keep pushing. You can keep pushing. We haven't broken yet after all the chaos that's happened so far. Yes, mind you, some of it is lagging, and a lot of it is lagging. We haven't truly broken yet. So that's one thing to kind of keep in mind there. Continued jobless claims pretty much came in flat. So a lot of the same folks are still jobless. A few of them, about 13,000 of them, found jobs. Initial jobless claims came in a little higher than last time, but again, this used to be a big market mover. But when you have ADP non-farm employment coming in and everything that's happening, which I'm going to connect to for in a second, because in the regular markets, in the regular world where you're not in quantitative tightening and when inflation isn't running hot, this is actually very good data. This is actually a signal that, okay, the markets are healthy, labor market's healthy, very good. But the reason this is a little bit weird and a little bit shaky for markets right now, and we'll dive deeper into the causational reaction that it had, is because of Jerome Powell coming out consecutively saying that, hey, we're going to need a lighter labor market, we're going to need a softer labor market because in order to tame inflation. So that's the big thing there. You also had JOLTS data come out. The JOLTS job opening data came in a little lighter. I was expecting this to kind of give the market a little bit of relief because it came in later, but it didn't do much, actually. It didn't help at all. We didn't get like a 10 a.m. pop or anything off of this since it came in later. But again, I think the markets were still awestruck about how heavily above the estimate this number came in. It was very parallel to the time when the JOLTS data came in and it kind of blew everyone out of the water and markets sold off. It was the same almost parallel situation that happened there. Now looking at tomorrow, which is Friday. So yesterday was Wednesday, today is Thursday, tomorrow's Friday. The reason I'm saying that is because it was a much shorter week thanks to the 4th of July and what's happening on 4th of July. Taking a look at that tomorrow, we have some more key unemployment data coming out that's kind of be leading the markets a little bit. So I'm dealing with a little bit of we're dealing with a lot of market events that are kind of coming back to back. So tomorrow you have two to three very important things. You have the hourly earnings for month and year over year. The reason this is important is because you don't want this number coming in too hot. Why? Because that induces what's called a wage price spiral. If the hourly earnings and people's earnings are going higher, manufacturers and stores see this, they raise their prices. It causes even though your wages went up, prices went up, you're inducing inflation. It's called a wage price spiral. That's kind of the terminology on it there. That's what I'm watching there. Non-farms payroll is also another item that I'm watching, very similar to ADP, excuse me. But on the non-farm sector, the participation rate expected to come in flat. It's how much of the market is actually participating. The big kahuna, though, at the end of the day, all this stuff aside, is unemployment rates. So again, the big thing that Jerome Powell and the Fed is looking for here is probably this coming in higher. But again, it's a weird situation because in a regular scenario, you don't want this number coming in higher. You want this number actually coming in lower. It means markets are healthy. It means your labor markets are healthy. It means everything is churning, everything is moving very well. But here, people are actually watching and looking for to see, hey, can we get this number a little higher to appease the Fed's lighter labor market to eventually show them that, hey, things are starting to break down with all these rate hikes. We should probably pause and slow down on the rate hikes because we're going way too far. We've already gone really far, really fast, about 500 basis points in a little less than a year. So that's kind of what we're watching here. And the Fed's meeting minutes came out yesterday, which projects that they're probably going to get 2 more rate hikes, 2 more 25 basis point rate hikes, which would put us around 5.75 to 6%. So you're setting up for a wild scenario. So based off the data that we've gotten so far, you have a CPI print that comes out, I believe, next week or the week after next week. What if that CPI? So next week you have the CPI print coming out, which I'll do a video on that as well. The CPI print, if this comes in hot because core didn't really move too much, it kind of opens the floodgates for a July rate hike. And personally, I think that we're going to get a July rate hike either way, because the reasoning being that, hey, like, labor markets are strong, they can handle it. Core didn't move much, which is the big thing that they're harping on. So it kind of opens us up. Plus, you're not going to get another FOMC until September. So August, it's kind of like they're off for August, and then they come back at the end of September. So that's one thing that I'm kind of keeping in the back of my head that, hey, does the Fed want to go hands off for June, July, August, and then come back in late September? Or are they going to hit it with another 25 basis point rate hike and then come back towards the tail end when everything kind of cleans up and clears out and takes a look again at September? Because technically August is a skip because there's no rate hike. So that month you're kind of off, because you only have 8 FOMCs every single year. So that's kind of the big thing that I'm watching there into tomorrow is this unemployment rate coming in. That's going to be the big kahuna that kind of sets up the path, and that comes in right before market open. So it kind of gives, the cool thing is it gives markets the ability to kind of adjust and see what's going on. So let's take a look at some of the today's price action. So let's see how some stocks are reacting to this. But before we do, real quick, I want to show you how the bonds market is reacting to this here on the side. So let me just zoom in. So the bonds market is kind of front running this scenario, and we've seen the 5-year, the 10-year ran up to over 4% again. The 2-year is not listed here, so let me actually go to the actual bonds market here and show you guys the 2-year. The 2-year hit 5% for the first time since 2007, which is kind of like a historical high for us, which signals that people are moving, our liquidity is moving from the stock market into the bonds market because it's a less riskier asset. Bonds are less riskier than stocks historically, so that's why it goes there. So if you take a look here, you can see the 2 years at 5%, the 10 years at over 4%. Tech stocks hate when the 10 years high are running. Yesterday, we saw the 10-year start peaking around 3.8, 3.85, 3.9-ish, but tech didn't really react too much. Tech bounced at the open, but today it's been the inverse. Tech saw 4%, freaked out. Labor data came out, freaked out, and we began the sell-off. And we're going to look at some of the price action there. So to me, this is a lot of wildness. And of course, if you're a recession bug, if you're watching the recession, that 10-2 spread, that inverted yield curve is very inverted. So the fears of a recession are still in the wings for us. And the Fed, mind you, the reason I'm bringing this up is in yesterday's meeting minutes, they said, hey, the chances of a mild recession are there. So they're keeping that in the back of their heads as well. So let's take a look at some of today's price action. So I want to show you, run through a few of the stocks that I like to take a look at to see where markets are going, one of them being Tesla. And we can see here that Tesla had a massive run on the fact that, hey, we're adding more people to our charging networks. Then they came out with their big beat on their car delivery numbers. And today we can see that Tesla is taking a bit of a breather. There's a big gap here on Tesla that I'm watching very closely, which would be a heartbreaker if it fails, but I prefer gaps to get filled than just to get left open to the wild. And if you want to see here, the gap is from the, if you ever want to see where the gap is, you can kind of eyeball it from the high of the candle where the candle starts, when the gap starts, and the low of the candle where the gap kind of had hit its peak point. And you can see here that partially the gap has started to fill. So the gap is between 263.10 and 267.08. So you got a bit of a gap there. Which if things continue to get ugly, unemployment tomorrow comes in at 3.5, like, which is a good sign. Like for a regular economy, that'd be like, oh great, unemployment like went up, but now it's came back right down. It freaked markets out. So I'm watching that very close on Tesla. Apple, let's see, is it still the $3 trillion behemoth that everyone wanted it to be, and no, it has shed its $3 trillion market cap slightly. We're at 2.99 trillion, but you can see here that it's teetering and trying to hold that 50 exponential moving average. This gap pretty much filled, but you did form a brand new gap here, so hopes are maybe in the near future we can kind of chug up and kind of fill that gap on the way up and get back to 3 trillion. But again, this is the thing with Apple, is getting to the 3 trillion party is kind of not the best, not the most fun for Apple, because the last time it happened, it kind of sold off again. And right now, I don't think it's because of the 3 trillion. I think it's because of the macro market events that are going on with Apple. Last but certainly not least, we have to take a look at Meta. Meta launched their brand new Threads platform last night at 7 p.m. And look at it. It's been very, very successful for the stock. The stock price likes it. It can't get over 300 just yet. It's still holding on there, but it's kind of fighting. Even through the bloodshed of this morning, it kind of came down to a low of 292.50, but it's kind of bounced, closed the candle at 296, and even this candle has been testing the peak of 298. It keeps touching it, but it cannot break over that level just yet. So it's kind of fighting that battle there, that 298.12 range. Was hit 1, 2, 3 times right now with 3 heavy volume candles, and hasn't been able to get up there. So we'll have to watch that very closely. And for a downward move, I'd probably be watching for the 90 MA break and then the break of the 292 again. But you can see here there isn't much of a volume wall here. Maybe the 20 MA can catch you on this volume wall here, and then the 50 catches you here on this volume wall. So that's kind of where I'm watching very, very closely on Meta, because they just launched Threads. Threads is a lot of hype behind Threads. I wouldn't say a lot of fun, but a lot of hype is behind Threads. So I'm kind of like keeping that in the back of my head to see how Threads operates and goes. So that was a lot of fun. But that brings us to ES. So if you guys know, we do event contracts here. But before we jump into the events contracts, I want to do a little bit of analysis on ES, which is the S&P 500 futures that I like to use event contracts for. Of course, with event contracts, you guys have probably, if you've seen the show, if you haven't, let me explain them to you. You can trade ES, you can trade the NASDAQ, Dow Jones Industrial, sweet crude oil, that light sweet crude oil, gold, the Russell 2000, euros, Henry's natural gas. Of course, I'm joking. It's not Henry. It's Henry Hub natural gas, silver, copper, and of course, for the crypto bugs, you got Bitcoin. So you can trade these futures contracts. The cool thing about futures contracts is they're capped at a certain gain and a certain loss that you can take. So the loss you can take maximizes that whatever you paid for it. So how these contracts work is you either say yes, you're going to close above a certain level on this, or you say no, we're not going to close above a certain level on this. And of course, right now these are deep in the money, right? Because right now the ES is sitting at 44.20. So we come down to 44.20, which I'm not sure. So take a look at 4,400. So if you're saying we're going to close above 44.20, so which would be 44.25 in this interval here, you would click yes. If you say we're not going to close over 44.25, you can click no. And the cool thing is it maximizes your pricing at this price per contract. So it's at 8.25. So each contract really costs $8.25. It doesn't have the 100x multiplier that options pricing tends to have. So that's one thing that you can kind of keep in mind, which kind of minimizes your risk scenario here, and you can kind of enter the world of trading these assets, especially if you're trading options. I think this is a good way to get your feet wet, because the contracts move very similarly to options contracts where they react to the price action, but here you're kind of capped at what you can spend. Now, let's say you're correct. Let's say you say yes, excuse me, no, we're not going to close over 44.25, and you buy this for $12. At the end of the day, this will go to $20. It maximizes your gain max at $20 a contract. So then when you hit the 20, at the end of the day, these are 0 DTEs. They're only for the single day. Once it closes, you're done for the day. And if you're correct, you can cash out your contracts at 20 per contract. If you're wrong, sorry, goodbye, you can leave. But the cool thing is, just like regular options contracts, throughout the day, you have the time period to be able to come in and say, hey, I want to take profits, or unfortunately, if you pick the wrong side, you can cut your losses there. So you can kind of do that. You can also do cool little strategies like strangles. You can buy multiple across the board. You can do butterflies, all the cool stuff you can do with options. You can do the same thing here manually and do those setups there. So that's kind of the optionality of there. But let's take a look at ES. Let's see how ES is reacting. And man, oh man, this thing has been very, very ugly. I've been talking to my team about this for a few days now. I've been watching this line here, this kind of the support beam here. It's kind of like there's like a mini little channel was forming here, and then it kind of gave out. And this morning, as the data started coming out at 8:30, you can see that ES really reacted 1-to-1. Let's go to the 30-minute charts. We can see right at 8:30 when our good friends released their data at 8:30. We can see here that how everything kind of reacted. So already at 8 o'clock they were front running this drop. So I just want to double check that this came out at 8:30 and not 8:15. Oh, it came out at 8:15. Okay. So let's do a 50-minute chart. The cool thing about the different candles is you get all your different opportunities. So you did. It looks like you had a little bit of front running here into the evening. I remember when I was looking at it this morning, you had a little bit of a sell-off here. I guess a few people had a little bit of an inkling, but it wasn't too much. And then once the data dropped at 8:15, you had a big flush here, and things started kind of going. And as more data came out, it wasn't on the side of a lighter labor market as much as we thought it'd be, especially jolts at 10 o'clock right here. I was expecting to have a little bit of a pop, and you can kind of see you had some slight little attempt here, but the bears are in full control. You can see here it's all selling volume. A lot of volume coming here on the seller side, and they've been kind of taken full control. So if we go back to the hourly chart, you can see here that we ripped clean. We ripped clean. This yellow line right here is the 20 simple moving average. We ripped clean through that. We even ripped clean through the 200 exponential moving average. So the yellow is the 200, the 9 is the pink line right here, and we've got the 20 in red and the 50 in blue. So we kind of see the color coded scenario that I have here. If you want to reference it back, they're up here. But this thing kind of came down to the 44.20.50 fib level that I have. These fibs, I can give you, let me give you the range that I drew these fibs over so we're all on the same page. These fibs were drawn, I went back in time a little bit. I think they're from March 29th to April 18th, if I'm not mistaken, but we can double check that together. So you can see here, yeah, from March 29th to April 18th is kind of the range that I have on these fibs here, because that's kind of the range that we were trading at, and we're right there. We're kind of I'm liking that fib range specifically for what's going on here too. I had an older fib range in there, but we kind of fell out of that. We went above it, so now I'm dealing with this one, and we're sitting right on it. And you can see this volume wall is parallel to that fib. That's where kind of the magic of the fibs. If you find the right range that you like, you can kind of line up. And it's trying to hold here. It's trying to bounce here. It's working really hard to do that, but unfortunately, it's having a lot of trouble. You need the buyers to step in, and buyers are exhausted. They've been trying to bounce this thing all morning, and they haven't been successful. If you look at something like a 3-minute chart, on something like SPY or SPX, you'll see that they've been trying to get this thing to bounce, and unfortunately it hasn't been. So the way that I'm seeing this here is especially here that our RSI is extensively oversold. We're at 12 on the hourly chart. That's extensive. Let's look at the daily chart real quick to see where we are on the daily. We might have some more room down. See, this is the thing. When you're on the hourly, everything looks fine and dandy, but if we look at it here, we went to it. If you look at it here on the daily chart, you can see here that things aren't as beautiful as we want them to be. We're still on a massive train. We've got one day of chaos where we're down 1.34%. It's not the prettiest. We opened at 44.83. We're down to 44.20, so about a $63 drop, $63.25 to be specific so far to our low end. And we're giving out the low end right now. We're very close to the low end right now, sitting on the 20 simple moving average. For anyone who uses Kelter bands, we're right on that middle Kelter band. We were above the Kelter band. It's kind of recalibrated itself to the mid band here. So this is the point where you either bounce or you break down and you come down to the lower end of the Kelter band. And again, it doesn't have to happen in one day. You've already had a lot of exhaustion happening here, but your RSI is even telling you, hey, we do have more room to the downside. If there needs to be on the daily chart, it can go lower, but you might get some small slight pops on the hourly chart here that could kind of give you some hope, I guess, here. But again, the rhythm has been set for tomorrow, for what's happening tomorrow, where probably unemployment might come in better than last time because of all the new ADP jobs that were added. So 44.20. So in the world of event contracts, what would I be doing today if my account was ready to go? Let's take a look at it. So right now I'm seeing that we're dancing with 44.20. 44.20 is not my friend here. I don't know why I did that, but I don't know why I moved that one by accident, but that's why you should always lock your lines. I'll come back to the recording and adjust that later. But 44.20 is where we're dancing here. So right now, with everything going on, I would be watching very closely to see. I would say, since my options here are 44.25 and 44.40, so let me just zoom in case the screen's not big enough. My options here are over, so there's a high chance you close over 44.40. There's a low chance that there's also a high chance, again, you can see that more expensive the contracts are, the higher the chance of this happening. You're kind of built in the risk reward in there. So personally, today seems like a day for me where I'd probably be betting that we do not close over 44.25. So I'd probably be buying a few of these no 44.25s because of where I'm seeing this thing going, especially as this is kind of bleeding out. If this volume wall gives out, you'll probably get a few pops to 44.28. Maybe let me reassess for a second. Let me take a step back. Taking a look at what's going on here. So this volume wall is holding up decently, but it's a big one. And then you have one more right under it, 44.17, the 44.17 range. So kind of this 44.20 is probably going to iron wall it for a little bit here and kind of hold it. Again, not guaranteed, not financial advice. Obviously, we're just discussing and having fun here. Taking a look at this here. Then the 44.25 is up here where it's kind of been wicking to. This is what I would do, just kind of for fun on a day like this where things are really, really ugly. I'd probably buy, since they're pretty affordable, I'd buy a few 44.25s on the yes end, buy like 10 of those, buy 10 44.25s on the yes end that it could, just in case by the end of the day you do get a pop. RSI is low. You could see bulls step in after lunchtime, come in here and kind of give us the move. So I'd probably buy like a few of those just for fun. Again, the cool thing is they're $8 a clip. But really, if I was inclined, if I had to pick one where I'd be like, okay, this is where I'm putting my stamp of approval, my stamp of approval, my stake in the ground would probably be we don't close over 44.25. And if you want to give yourself some buffer room and you don't care, you can kind of go up to the 44.30 and be like, hey, we're not going to close over 44.30 because of the chaos happening here, and 44.30 is all the way up here. So that's kind of where I would kind of be watching very, very closely, because right now we're at 44.21. So if things bounce, your 44.25s would kind of save you. Like, okay, cool, we bounced a little bit, we close over 44.25 at the end of the day. But if no, your no buffer would kind of kick in and kind of help you out there. But you can see here, this 44.20 level, this fib is kind of where all of the action is happening. All the price action is happening. Now, if we were looking for, if these weren't 0 DTs and it was like a few days out, like I could buy a few days out, I'd probably load the boat with these no 44.40s, just because like the unemployment stuff is probably like not probably going to be the best situation that happens here. So that's kind of like where I would put it. Stamp in the ground, I'd probably buy a few no 44.25s, and then kind of to balance it off just for fun, I'd buy a few 44.25 yeses. Just for fun, just because I like to, because like the cool thing is these things are pretty affordable and you can kind of have the fun with it versus like real futures contracts or real SPX contracts or SPY contracts where it's like, all right, 0 DTEs at the end of the day I could get smoked, but these, hey, at the end of the day we get over it, $20 you cash out, you call it a day, and you can probably go buy yourself a nice dinner there. All right, folks. I hope you had some fun today. I hope you learned something today. I'm going to be back next Thursday at 11 a.m. Eastern Standard Time on Tradeovate. Make sure you subscribe to the channel. Make sure you subscribe to the platform. Sign up for Tradeovate. Start trading these event contracts. They're a lot of fun, especially if you're a new trader. Chart some stuff out. Come to Tradeovate. Put some action on the boards. Have some fun with it there. And it's kind of more simpler before you put some real iron on the fire with real contracts trading. I think Tradeovate's event contracts are a lot of fun, especially for those crazy volatile days like today, where things are going crazy. SPY is choppy. This is probably where you want to put your money, because you also have some theta protection, because it's a binary variable situation, yes or no. You don't have really theta kind of like burning you out, especially if you're on the right side. It's kind of helping you out. So all right, guys, thank you so much for watching. I'm your host, Ryan. Thank you to Tradeovate for sponsoring this. Thank you to Place Your Trades platform for this awesome opportunity to do this. I'll see you guys next time. Bye-bye.